Hey there, everyone, and welcome to the Final Bar. It's Wednesday, May 22nd. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the tools of the technical analysts. Today, an interesting day, sort of a nice, sort of slow and steady, holding their ground sort of action until the Fed minutes come out, and the market took that as a bit of a ding to the downside. Risk assets rolling over into the afternoon. Nice bounce going into the close, but the damage was done. We'll do our best to debrief on that market action. Great guest, by the way, today, Mike Singleton, with a really just little mini masterclass on combining macroeconomic and fundamental ideas like valuation with the charts, with the technical. So can't wait for you to hear some of his thoughts on the current market environment. It's a growth story, according to Mike. Let's get to our market recap and let's look at how these charts have evolved from yesterday's close to today's close. Before we do that, I do want to start with a poll. We had a poll going on our social media platforms recently. What will be the S&P 500's total return in 2024? Now that we're in mid-May, what do you think happens between the beginning of the year and the end of the year? 67% of you, all kinds of bulled up, looking for an above average year for the S&P 500, up over 10%, about 23% of you saying between 0 and 10%. We're a little above there, right? We're sort of 15 to 20%, depending on what benchmark you're using year to date so far. Only 11% of you saying 2024 is going to be a down year, and I don't blame you given the experience that we've experienced thus far. But you know, it's interesting if you look at something like the returns here. Here's SPY. I've got this little performance table. So here's the SPY. I was a little overshooting it. Sorry, up about 12% year to date. The QQQ a little bit less than that, up about 11.4%. So again, most of us saying this is just the beginning. Now, what you have to remember is if the total return for the S&P is 15%, that's no guarantee and probably highly unlikely that we would go from a positive 12% in a straight, gentle move up to a positive 15, 20%. So even we could end up much higher than current levels, but have big drawdowns in the middle. I think that is the benefit of the technical analysis toolkit, is recognizing the fact that markets just don't go from point A to point B. There are big drawdowns that happen along the way. By the way, my guest today, Mike Singleton, has some data to look at actual average returns in a bullish year versus a bearish year. I'll let him tell you about his findings and what that might mean for market expectations in 2024. Don't forget to follow us on all the social media platforms, by the way, so you don't miss the next poll question. Continuing our market recap, the S&P 500, nice bounce going into the close. The middle of the day in the afternoon after the Fed minutes came out, came down a bit because there's a lot of, discomfort's not the right word, but certainly some speculation on what Fed governors' expectations may be for Fed policy, and a little bit of indecision happening. The S&P finished the day down about 1/3%. That's finishing at around 5307. The NASDAQ composite down slightly less, about 0.2% lower. The Dow, of course, well below 40,000 now, down about 0.5% from yesterday's close. Mid-caps, small caps, all down. Mid-cap S&P 400 index down the most, down almost, we'll call it 0.8%. The VIX moving slightly higher, but only about 0.4 VIX points. So we're back above 12. We're around 12.3. We're still in the low teens. Low teens is a low volatility environment. We've had a low volatility environment for most of 2024. And what that basically essentially means is the market is moving higher, and it's sort of a slow and steady grind. It's an accumulation phase is how I would describe it. Market trending higher, volatility very low, classic bull market behavior. And the good news about that is the red flag should be any spike in the VIX. If VIX pops higher, that tells you an increase in indecision, most likely an increase in anxiety and fear, and that usually is reflected with risk assets like stocks going lower. But for now, low volatility environment, all is well. Rates actually started the day a little bit higher than where they were yesterday, but kind of came back down to earth through the course of the trading day. At the end of the day, the 10-year yield moved slightly higher to 443. The 5-year point's around 447. The long bond yield is around 455. So we still, of course, have that inverted yield curve that has been, I guess, plaguing the markets for quite some time here. Financials, of course, overall doing quite well in 2024, all else being equal, and even with an inverted yield curve. I think that would arguably be the market pricing in more of a writing of the yield curve over time, more of a normal shaped curve, which would be better for especially regional banks, which are starting to do quite well here. Bond prices slightly higher. The TLT was up about 0.1%. The dollar index up about 1/3% from yesterday's close, and that's using the UUP. Commodities overall, a lot of red here on this page. The DBC was down 1.4%. Gold and silver prices both down. Copper prices down. The CPER, which is a copper ETF, was down almost 6%. Crude oil prices are down. Besides natural gas moving higher, corn kind of flat for the day. Most of the commodity space was in the red. Cryptocurrencies, a lot of red as well. Bitcoin, as we are preparing to record the show, chopping all around that 70,000 level. As I've mentioned many, many times, cryptocurrencies, along with other assets, tend to find meaning at big round numbers. I would argue that is not a coincidence. I think that it actually is a well-documented fact. The fact that orders tend to be clustered around big round numbers, that's actually been proven out with academic research. So it is not just you. That tends to happen. I always talk about big round number support or big round number resistance. The reality is Bitcoin is sort of flustering around that 70,000 level, currently slightly below, just below 69,700. Ether prices right above 3750. Both of those, though, down from yesterday's close. And I put close in air quotes because these are cryptocurrencies that trade in a 24-hour session. Looking at the 11 S&P sectors, a little bit of movement here, but at the end of the day, sort of some up, some down. 4 out of the 11 S&P sectors finished in the green. Technology and healthcare, your top 2 sectors, both up about 0.2%. Industrials and communications, both up about 0.1%, so just slightly above where we closed yesterday. The other 7 sectors were in the red. Energy leading the way lower, down 1.9%. The utility sectors, which often has been the top or one of the top performing sectors, actually showing that these stocks can indeed go back down 1.2%. Consumer discretionary materials both down about 1% from yesterday's close. Looking at the mega cap growth leadership names, only 2 of these, this group of names moving higher. Meta up about 0.7%, Microsoft up 1/3%. On the downside, dragging this group lower, you have Tesla down 3.5%. Tesla, again, very underwhelming from a technical perspective. Certainly when you compare that to some of the leading stocks, and I'm thinking of sectors like industrials with building materials doing quite well, insurance companies in the financial sector. Most stocks in most sectors are in some sort of constructive pattern. Tesla's kind of languishing, and again today down about 3.5%. Netflix down 1.6%. This is as it's testing all-time highs along with Alphabet. Both of those stocks sort of at or near all-time highs, but coming off a bit here today. Let's go to the daily chart of the S&P 500. Now, the daily S&P chart, I feel like, changed quite a bit. Earlier in the day, it felt like we might have a bearish engulfing pattern where day 2 engulfs the body of day 1. On a little candle chart, you can see what I'm talking about, right? The big up day didn't quite have a higher open, so it really wasn't a perfect engulfing pattern, but certainly felt like there was at least a short-term distribution. But by the end of the day, we're kind of mid-range and not a bad day. You didn't really closed down too much. And again, what happened was we had that big up day last week. I think that was Wednesday, Thursday of last week. And then we've basically been sideways since making that new high, right? Closing above 5,300 for the first time. That's been it. Since then, the market has been sort of choppy, sloppy, sideways. Having said that, though, right, if you literally stand up, take a step back from your monitor, we are making higher highs and higher lows. And that is by definition what an uptrend is made of. And so I think it's less about, do we make a new high? I think that's already happened. The question now is when that next pullback happens, and it will happen at some point, do we establish a higher low? And what that means from a technical perspective is that you can basically, as long as we remain above like 4,950, 5,000 on a pullback, this is still a pretty good trend, right, over time. And only when we break below there would you really have to reconsider and think about some more aggressive downside targets. That's the beauty of charts and thinking about more of the trend in highs and lows is it tells you what sort of room you have, what sort of volatility you can withstand and still have the primary trend being a particular direction. So I would, generally speaking, I think this market is innocent until proven guilty. A lot of concerns to be had. And yesterday when I talked with Julius de Kempener, if you missed that one, make sure you go back to that discussion because we had some great thoughts about the reasons for caution, right? And what may not be ideal in this environment, but the price keeps going higher. I do want to briefly just look at the SPY here, showing the higher highs that the S&P 500 has experienced from March to May. And the reason why I want to start there is because I do want to point out that the Midcap S&P 400 has not done so. So while the S&P has made a new high, the Qs, the NASDAQ 100 have made a new high. Mid-caps actually have yet to break above their March high. Small caps have certainly not made it above their March high as well. So we're starting to get a bit of a divergence between large caps, mega caps, growth leadership names in the form of the NASDAQ 100, and mid caps and small caps actually both making lower peaks. The equal weighted S&P 500, the ETF RSP, is a great way to sort of check out that equal weighted index, also not making a new high. So now in May, we're starting to get some divergences where the S&P and the NASDAQ are making new highs, but a lot of other things that you would hope would also be making new highs if the trend is positive, not necessarily doing so. Let's look at maybe one or two measures of breadth. I don't want to look too much at them, but I would say, where do we want to go? How about this one? The advanced decline lines, overall though, are making new highs. And what's interesting is even though the mid-cap S&P 400 and small-cap Russell 2000, the S&P 600, are not making new price highs, their advanced decline lines are all making new highs. So the AD lines for the New York Stock Exchange, for the large cap, mid cap, small cap indexes, all breaking above their March highs already. So the primary trend positive according to that measure of growth. The other thing I would say that's probably the most encouraging, the fact you have a lot of stocks making new 52-week highs, and that's been the story here for the month of May. These green bars represent the number of stocks in the S&P 500 on any given trading day that are making new 52-week highs. Just today, about 10%, 9 to 10% of the S&P made a new 52-week closing high today. That's not too bad. So let's keep in mind that the trend is positive. As long as stocks are going higher, the breadth conditions, the new highs are all supporting that. Look for changes, and we're seeing a downward slope as maybe there's a bit of a slowdown in new 52-week highs as the S&P is languishing just above 5,300. Let's keep an eye on that for sure. Go to a chart of gold just to highlight. This is something that came out of my own review this morning. I was looking at the charts as part of my morning coffee routine. I couldn't help but notice this bearish momentum divergence on gold. And it's not necessarily as clear because you have this big weird update there. If we change this from open, high, low, close to just closing prices, it's a little easier to see that divergence. There we go. The high from April to May on a closing basis, very different than the momentum. So we're overbought here in April. We're overbought back there in March. We're making another new high, but we are not overbought. So that's higher highs in price, lower peaks in momentum. The last time you had that clear divergence, arguably December of 2023, you had one. We had a bit of a 6-week pullback after that. Here in April, May of 2023, we had another one of these, higher highs in price, lower peaks in momentum. That led to that downtrend that you saw in gold prices, leading a little bit when stocks actually sold off August, September, October of last year. So we are starting to get some bearish divergences in precious metals. Something interesting to watch there. Now, that on its own is not the end of the world. Price action is most important, but this often coincides with a major peak. So something to watch on the chart of gold. You're now starting to get a bit of a decline in the momentum picture. Let's finish off our market recap looking at some individual stocks. Nvidia trying to get to new all-time highs. This is they're reporting after the close here today. It's a little early to see what the after-hours trading necessarily is going to be, but I think all eyes on Nvidia. One of two things probably happens, right? The bull case from here, strong earnings from Nvidia. A lot of other semiconductors, of course, have looked quite strong. We've talked about, Microchip, MCHP made a new high today. KLAC just breaking out, making a new closing. Actually, not quite a closing high, but it looked like it was maybe going to be doing that, but certainly stronger in the last week. You compare that to Nvidia, which is sort of a wait-and-see mode, sitting on your hands, I guess, as an Nvidia investor. Now, the peak just below $1,000 a share happened in March, and again in April. That was right around $950. You can see we're right up to those levels. The bull case, I think, is Nvidia above 1,000. If you're thinking of that sort of catalyst, these sort of markers that would confirm that the bullish case for stocks is alive and well, Nvidia breaking above 1,000 would certainly be a big thumbs up or a big check mark in the bullish column. But the alternate side, what if they miss earnings? What if the momentum never really gets any better than this, and the stock all of a sudden is making a big sort of double, triple top pattern with the momentum declining? Nvidia could be the perfect example of the type of price action that does not confirm new highs. So as mid caps and small caps, as some of the momentum pictures not quite as strong, I'm curious if Nvidia will be that next upside catalyst or not. Open question. We'll see what happens with earnings. First Solar, we highlighted, I think, on yesterday's show, and if not, I certainly meant to. This rounded bottoming pattern just continues to impress as the stock makes higher highs and higher lows. Today, another big move higher. This is taking it to a new high, closing just above $250 a share. That's up about 19%. So renewable energy, particularly First Solar and other solar names, really accelerating to the upside. Speaking of upside acceleration, look no further than the pharmaceutical group, which is in the healthcare sector. Moderna having a nice update as well, up 14%. And again, this is just the latest move after this breakout. I think the real technical story is the breakout here. January, March, April, resistance all around 110, 115. We finally broke above there. We briefly pulled back to test that breakout level. Then it's off to the races. So today's big update is just the latest move confirming that breakout that has continued to accelerate to the upside. Pfizer in the same group, of course, one of the big pharmaceutical makers, closing above its 200-day moving average for the first time since January of 2023. This is a stock that has been in such a clear distribution phase for so long. And I remember being asked along the way here, is it time to buy Pfizer? Is it time to buy Pfizer? And I'm thinking of Walt Diemer's famous quote, the time to buy is when you don't want to. Like when you stop asking whether it's the time to buy Pfizer, that's probably when it's at a good buy point. Look at what happened in December of 2023 when it hit support. It's probably better to look at an unadjusted picture, by the way, but it's not too different. We found support around $26. We basically retested that a couple times in March and then in April, and then we finally broke above it on an unadjusted basis. We're still briefly below the 200-day moving average. On an adjusted basis, which is our default, we're closing above the 200-day for the first time in a long while. The relative strength may just start to be improving here, but I like a stock like this that has been in a primary downtrend, that has found some stability, and now starting to break above recent swing highs. We're now making higher highs. Do we make a higher low? If so, pretty encouraging. We talked about the bearish momentum divergence in gold. If you flip that chart over, it's kind of like the chart of Electronic Arts. This is a bullish momentum divergence. We actually have lower prices April into May, higher momentum, so we're oversold on the first low. We make a lower low, but on higher momentum. That's a classic bullish momentum divergence, what often happens at major lows. You can see that EA has rallied over the last 2 weeks after sort of confirming that bullish divergence. Today, rotating a little bit higher, up almost 5%, closing back above the 200-day moving average and making it above the early May high, which I think is pretty encouraging as well. We'll finish with, let's see, what's not looking particularly good. Lululemon down another 7%. Charts like this, I don't think are that surprising. And when you ask, what happened for this gap down, I would say what happened is this is a stock in a downtrend. This is just the latest gap along an entire sort of a negative period. Look how the momentum overall has been in a consistently bearish range. The relative strength is fairly negative as we keep going down. And so we make lower highs and lower lows. That's what a downtrend is all about. So as much as it can be tempting to buy a falling knife, the danger is something like Lululemon happens in your portfolio and the stock just keeps moving lower. I would encourage you, one of the great parts of the technical toolkit is to avoid this kind of chart until you see signs of accumulation. Look at indicators like PPO. Look at some weekly charts. Look for signs of accumulation. Not seeing it yet on the chart of LULU. We have a great guest today here in a moment, Mike Singleton of Invictus Research. Before we do so, just one quick reminder, we would love to hear from you, particularly your questions. We're going to do an all mailbag show on Friday of this week. We'd love to answer one of your questions in our next mailbag episode. Our email is thefinalbar@stockcharts.com. We're on X @FinalBarSCTV, so just tag us in a comment there. Or on YouTube, just put a comment below the video. We'd love to hear from you, love to get your questions, and hope to answer yours in our next mailbag episode. I want to welcome on today's guest, Mike Singleton. Mike's a senior analyst at Invictus Research, coming to us from Annapolis, Maryland. Mike, welcome back to the show. Markets making new all-time highs here recently. Overall, fairly encouraging, I would say. General sense of things, bullish, I would imagine, at this point.
Right. Thanks for having me, Dave. It's a pleasure to be back on the show. And I think that's right. I think there's a lot of reason to be bullish. And so the house view at Invictus is that the stock market is headed higher, and the economic data mostly supports that.
You just summarized what I think you have some really good visuals to illustrate the research that led to those conclusions. Let's get through some of those charts here. The first couple really talking about the economic growth story, which seems to be pretty robust looking at your charts. Talk us through these first ones. What do you see about the economic conditions here?
So on this first slide is the weekly economic index, which is a composite of 10 different high frequency data points collected by the New York Fed. It really tracks real GDP growth closely, but on a weekly basis rather than a quarterly basis. So it's a great high frequency, timely look at the real growth situation in the US. And we just want to point out here that real economic growth is accelerating. The last reading was about 2.2%, which is a multi-month high. It's well above long-term potential growth in the US, just a very strong trend. And the reason this matters for stocks, maybe it's obvious, maybe it's not. I think that there are a lot of random walk, practitioners that might be surprised to hear this, but the real economic growth data and the stock market are highly correlated. So that's what we're showing you on this next slide here. So when real economic growth is accelerating in rate of change terms, the stock market tends to do much, much better. So that's what's happening right now. We expect that to persist at Invictus. And so that's one reason that we expect, earnings growth to accelerate and the stock market to continue to perform well through the rest of 2024.
I love that illustration. The scatter plot really shows that relationship between the two. Stronger economic growth, stronger stocks, and seems to be sort of where we're at right now. Talk to us about the materials sector. This is an area of the market that's starting to show some strength. Here we're looking at an equal weighted ETF tracking materials. Talk us through the thesis here.
So at Invictus, our economic view is faster real growth and faster inflation. That's an economic regime that we call reflation. And if you do a back test of the different equity sectors, basic materials is the second best performing equity sector through historical reflation. So, in principle, just based on the economic data, this is a place where we want to be looking for long ideas. And we look at the charts to either confirm or refute that thesis. And when we look at the chart of the equal weight basic material sector, it looks pretty good. That looks like a multi-year base, strong absolute performance. And if you look at the relative performance, basic materials have been outperforming the broader market, say the equal weight S&P 500, since the beginning of the year. As it happens, that was when we pivoted from deflation to reflation at Invictus. So that was a good call. A little bit of luck never helps. But essentially what we're pointing out here is that the market is confirming or pricing in our reflationary view at Invictus. And we want to be looking for opportunities to buy basic material stocks when the setups are good.
It's interesting, and this next slide is really, I think, showing the relationship between inflation and this relative performance of materials versus staples, right?
Right, exactly. So I think that the slide sort of speaks for itself. But if you look at the ratio of material stocks to staple stocks, it tends to track or rather lead the government inflation measures like CPI inflation or PCE inflation. So the fact that we're seeing material stocks, chemical companies, building materials companies, paper and packaging companies outperform consumer staples, which tend to be a little bit more defensive, a little bit more acyclical, that's a very good sign that inflation is going to accelerate. And that doesn't mean that we're going to see a repeat of 2022 or 9% inflation again, but could we see 3.5%, 4%, maybe even 4% plus inflation by the end of 2024? Absolutely. I think that's probably what the market is telling us. And, we want to respect what the market's telling us at Invictus for sure.
I love that. You're doing a brilliant job, Mike, of relating what I would say the technical, looking at the evidence in the markets, and more of the macroeconomic, more the fundamental, thinking about what these markers are actually tracking. Talk to us a little bit about the sentiment picture. I think a lot of people sort of are, predetermined to be contrarians when you look at sentiment data, right? Things are super bullish or bearish, and you think that's always a contrarian view. Talk to us about the relationship between sentiment and price action here.
Right. So the point of this slide is that sentiment tracks price over time, not the other way around. And so you can see that 14-week RSI momentum for the S&P 500 looks a lot like the AAII bull-bear spread on a little bit of a lag. So it's evidence that sentiment tracks price. And the reason that we were discussing it with our clients is earlier this week, there were a few high-profile Wall Street bears that became bullish. And we were asked, hey, does this make you more bearish? Is sentiment getting frothy now? Should we be pulling back because other people are getting bullish? And I think it's easy to do mental contortions, when people are, this person's bearish, should I be bullish? And it's not always super productive. The point of the slide is, through a bull market, when price is going up, you're necessarily going to see bears become bulls because sentiment tracks price. So if it's a bull market, you don't need to worry about people getting more bullish because that's a natural progression of a bull market. It doesn't mean the markets can't pull back if things, the markets get over their skis or whatnot, but it's not something in and of itself that should be a bearish input into your process. it's, it's natural, and it's something that you should expect to see if you're bullish and you're right over time.
Very, very well said. And indeed, I think we've seen some, extremes in sentiment, sometimes earlier on as things are really starting to progress. I think that's a point well taken. I love this next set of slides, really thinking about average returns. And this first one is looking at the average returns in the S&P over a pretty long time frame. Talk to us about what this should mean about our expectations here in 2024.
Yeah, so this is year-over-year returns for the S&P 500 going all the way back to 1905. And you can see that the average 12-month return for stocks is 7%. The median is 9%. Pretty good, right? That's why people like stocks as an asset class. But what you also tend to see is most Wall Street strategists will pick S&P 500 price targets that are, roughly 7 to 9% above, whatever the year-end price was when they're setting their 2024 target or whatever. Give or take a percent. And the reason they do that is because they don't want to go out on a limb and look silly if they end up being wrong. However, the result is that most of the time they're wrong, because through an average up year, the S&P 500 doesn't go up 7% or 8% or 9%. It goes up a lot more than that. It goes up 18% on average, and the median return is 16%. So if you're bullish on stocks and you expect the market to go up, whether that's because the federal government is stimulating the economy really aggressively, or real growth is accelerating, or the Fed is easing, you really should be looking for returns more in the range of 16 to 18% and less in the range to 7 to 9%. If you're really bullish, you should be expecting higher returns than what the average forecaster on Wall Street is. And at Invictus, I think we've pretty much said since the beginning of the year, we're expecting returns more in the range of 15 to 20%, driven mostly by earnings growth. Although when earnings is accelerating, a lot of times you get multiple expansion as well, because you see sort of animal spirits in the markets.
I love that. And it's such a great point there, Mike, because I find a lot of times we look at averages and just group all the bull and bear market phases in one big bucket. And if you think about it, bull phases and bear phases, up years and down years, end up having very different experiences for investors. I think that's a point very well taken. You alluded to this idea of valuations. Talk to us a little about the valuations here now, what that should mean relative to our expectations for returns here.
Right. So some of the most common pushback that I get against being bullish right now is valuations are high. You can look at the price to earnings ratio or the equity risk premium. By pretty much any measure, valuations are high. And most people think that's a reason to not be bullish. And as it happens, it is a reason to not be bullish over the next 10 years. It's not a reason to not be bullish over the next 12 months, right? So our cyclical outlook is pretty much unaffected by valuations, because the correlation between valuation today and 1 year forward returns is basically zero. It's actually slightly positive 3%. So higher valuations, slightly higher returns, although 3% is so low, it's almost meaningless.
I love this. I love this chart, this scatter plot here. So again, on the y-axis, you're showing the 1 year forward returns on the S&P, showing the valuations across the x-axis. And as you can see, there's no real clear relationship between the two. You compare that to previously, we're relating growth to returns, where it makes a lot more sense. Valuations make sense, it seems like, down the road and not necessarily for near-term returns. Talk to us about this next one and how that relates to the interest rate environment, if you could.
Sure. So I think that a lot of folks are also bearish because of the Fed, and maybe the Fed, doesn't actually cut rates this year, and, interest rates go up as a result. And I think that is putting too much emphasis on the Fed, which after the last 2 years sounds blasphemous, right? How can you pay too much attention to the Fed? But the reality is America is still a pretty free market, right? It's got a huge private sector. Right now, that private sector is accelerating. At Invictus, we expect that will result in, call it 12 to 13% earnings growth. In order for an increase in interest rates to offset 12 to 13% earnings growth, or EPS growth rather, you would need to see the 10-year increase 220 basis points, which would mean a 10-year treasury yield of 6.6%. Now, we think rates probably do drift higher. That's the house view. But 6.6% is way too high. We don't see that happening by the end of 2024. So if we're right about earnings growth, it's very likely that the stock market goes higher from here.
That's really well said. And we had Gina Martin-Adams of Bloomberg on not too long ago, made a similar sort of general points about the relationship and not being too pure out of a view of rates, and remembering that valuations have a couple moving parts in there to think about. I'd love to get to finish off with your last slide. We have about a minute left, Mike, but this is just a comment, I think, about just being on what side of the trend you're on. Talk to us about the work you did here, what your conclusions are.
Sure. So just on a technical basis, I think that you can completely ignore the economic data and you can just be bullish because of the technical data. And as a very simple data point, the S&P 500 is above its 200-day moving average. So why does that matter? What does this chart show? Well, it shows three different strategies. One is a strategy where you buy the S&P 500 when it crosses above its 200-day moving average and convert to cash when it crosses below. Strategy two does the opposite. So you only own the S&P when it's below its 200-day moving average. And the third strategy is just a buy and hold. Now, the buy and hold does have the best returns, in absolute terms, in 9.1% annualized since 1984. However, what we want to highlight is that pretty much every risk measure is superior when you're buying stocks in uptrends, right? Buying the S&P 500 when it's above its 200-day moving average. The Sharpe ratio is better. The Sortino ratio is better. The drawdown is much less. And, we would summarize this basically in a phrase. When stocks are in an uptrend, when they're above their 200-day moving average, good things tend to happen. And when they're below their 200-day moving average, bad things tend to happen. That's really the takeaway from this slide.
It's well said, and I love wrapping it up with a little technical exclamation point to your comments. Mike, that was an awesome review. That was 10 minutes going through valuations, going through economic conditions, materials as an interesting opportunity, the general benefits of being on the right side of the trend. Can't thank you enough for putting that all together in a brief presentation for us. Thanks again, Mike, and we'll look forward to having you on again soon.
My pleasure. Thanks again for having me.
That's Mike Singleton. Mike's a senior analyst at Invictus Research, coming to us from Annapolis, Maryland. I love that final slide. Again, it's interesting when you think about the buy and hold, and if that looked interesting to you, and it certainly can. What you have to remember, a lot of times that drawdown number is way more significant. It has more of an impact than you probably think it does. A lot of investors don't have the stomach to deal with huge drawdowns. So something that has better risk parameters, something that has less drawdowns, where things like the Sharpe ratio, the Sortino ratio are more attractive, just basically means you have better risk-adjusted returns. You have better experience going through, and you can weather those storms a little better. But a great overview of a lot of different macro and technical conditions by Mike Singleton of Invictus Research. Folks, that's it for the show. Thanks so much for joining us every weekday after the close. A special thank you to Mike Singleton of Invictus Research, joining us from Maryland. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.